Hello and welcome to another video on how to secure yourself financially. So in this section, where in here we have is the sec.gov, this beginner guide to financial statements. So I'm just going to jump straight forward into the last financial statement, at least in this section, and to make a quick recap. So financial statement, after all, they show you the money. So this section will give you some confidence. So when you're able to see a set of financial statement, you can make sense of them. So much like a CPR course train you to perform basic cardiopulmonary resuscitation, this section will give us this basic notion of how to read basic part of financial statement. So it will train us to be an accountant, much like a CPR course won't train you to be a cardiac doctor. So after all, the financial statement, they show you the money, and you have four of them. Balance sheet that show what a company owns and what it owns at a fixed point in time. Income statements, how much money a company spent and made over a period of time. Cash flow, the exchange of money between the company and the outside world, as well as the statement of the shareholder that show change over time. Show the change in interest of the shareholders over time. So this section only focuses on the first three, the balance sheet. The TLDR this is a snapshot of the company assets, liabilities, and shareholders' equity. Okay. So assets are any resource that a company has and owns. Liabilities are obligations that a company has to pay. And equity, or the shareholders' equity, is the total amount of money that the owners of this company invest in the company stocks, plus or minus is benefits or losses since inception. So generally this balance sheet is listed. Following is the formula: assets are equal to liabilities and shareholders' equity. So you can find, depending on the layout, something like that. Or in the case of Yahoo.com, when they list all of the assets at the top, followed by the liabilities and the shareholders' equity. And the assets are generally listed based on how quickly they can be converted into cash, meaning, so you have current assets that a company expects to convert into cash within a year. Okay. So for example, inventory or non-current assets, non-current assets that a company expect or will take longer than a year to convert into cash. And fixed assets, items that are not for sale because allow their business to run, such as machinery, office supplies, in my case laptops, desktop, keyboard, mouse, cell phones, internet connections, and so on. Well, that's not an asset. That is a liability. Okay, where now liabilities are generally listed based on their due dates. So when I look at here the due translation, exactly. Jesus. Due date. Okay. Based on their due dates. All right. So based on their due date, uh, uh, so you have is current liabilities, so liabilities that a company expect to pay off within a year, and long-term liabilities, as well as the shareholders' equity, something that I already explained. So it's the leftover money that belongs to the shareholders' equity if the company decides to sell off all of their assets and pay off all of its liabilities. So with that, okay, uh, then I look at the income statement, where you can think of this according to the set.gov. Okay, you can think of this as a set of stairs, okay, where you start at the top with the total amount of revenue, and once or in every time you go down one step, okay, you make a certain deductions associated with that earning. Okay, so when you reach to the bottom of the stair, you now have is the bottom line, or in other words, is a company made profits or not. Okay, so with this, you would all start with the total amount of revenue here. Okay, we start with the total amount of revenue, and then once we go one step down on the stairs, you deduct things like merchandise returns or discounts. So you reach to the net revenue, and here's when you deduct, for example, things like cost of sales, among other things. But here I'm just is describing is broadly speaking is what is the most deduction or the most common deductions that you do when you earn an income, okay, such as discounts or merchandise returns in the case of this company. Okay, once you do that, you reach to the net revenue. Then you have to deduct things like cost of sales, among other stuff. But this is it represents how much money a company spend to produce its good and service. Okay, the cost of sales. Once you do that, you reach to the gross profit, and here is when you deduct things like the operating expense that allow this business to run, such as marketing, uh, administrating salaries, or prototypes in new research in new prototypes or products, that kind of thing. So once you do that and deduct also the depreciation and amortization, you reach to the net income before interest, and that is interest that you have to deduct or add to the income statement based on how much money the company lent or how much money the company borrow. All right. Then you deduct the income taxes, okay, or the income tax, and ultimately you reach to the net income. All right. Again, this is broadly speaking is what are the deductions that a company must do. Okay? And then you look at the cash flow, okay, which report is the company inflow and outflow of cash, right? So this is important because company need to have cash on hand to pay this expense or to purchase assets, and it reviews information from the balance sheets and the income statement. And the bottom line of this show the net increase or decrease in cash. So with that, um, Generally, this is made of three parts. So the cash flow statement review the cash flow from one of these three activities: operating, financing, and investing. Right? Or in other words, is operating, investing, and financing. So the first is the operating, the first part of the cash flow statement. So if we are able to see here from Yahoo, let's say Coca-Cola, for example, okay, and also let's going to compare that with Apple or IBM, okay, which is good, right? Which is good. So, yeah, I'm looking here at the cash flow here. Oh, it seems like internet is gone. What happened? What happened? What happened? What happened? Okay, come on, man. Okay, we're going to reload this and reload this. No, you don't want to? Okay, what about the cash flow here? Okay, okay, the cash flow, that's right. And this is from Coca-Cola. Okay, but let me look at Apple here. I just want to look at Apple. Oh my God. Okay. Apple. Well, yeah. Nope. Not at all. Apple Inc. Yes, equity. Equity. Okay. Cool. Cool. Um, that's right. Let's jump here to financials. Okay. And then you get is this. The cash flow. All right. So the first part of the cash flow is the operating cash flow. Okay. Where now what it does here is analyze the net income from the income statement and conciliate with the total amount of cash that was used from operating activities. The most common operating activities you have operating assets and operating liabilities. Where operating assets you have is accounts receivable, inventory, prepay expense that a company incur for good and service that will receive. So, for example, premium insurance like health for medical coverage, home or vehicle to protect those belonging in the case of any potential damage. Liabilities such as lawsuits, disability that prevent you from working, or uh, long-term care such as home health care or nurse health care. Marketing, office supplies, rent, software license, maintenance contracts are another example of prepay expense. Intangible assets like patents, which is exclusive rights to provide to original or inventors so they can manufacture, distribute, and sell their invention over a period of time. The most common patent or the patent that changed the world, just to mention a few of them, from popular mechanics is uh, GPS. Okay, so this navigation system using satellites with passive ranging techniques, issued in 1973. maglev, this electromagnetic inductive system for stabilization and suspension vehicle, or for ground vehicles, issued in 1969. Electronic device, as their patent call, or aka iPhones, issued in 2007. Or things like CRISP, gene editing, this gene editing tool, for that, issued in 2014. So you get the idea. Another intangible assets are trademark, which is exclusive right. Is design, image, audios that uniquely identify this company from the competition. And you have here, for example, the famous quote from Michael Buffer: "Let's get ready to rumble." Copyright, which are exclusive rights to granted to original or creator of original works, so they can distribute, manufacture, and distribute and sell their inventions over a period of time, such as Coca-Cola, Netflix, Spotify, Twitter. Trade secrets is confidential data that company used to gain some competitive advantage over process, formula, or customer list. Goodwill, company's reputation, branding recognitions, and customer loyalty, as well as customer relationship. Okay. And when it comes to investment in affiliate, which is another operating asset, so this is with the sole purpose of earn a return or gain some competitive advantage, perhaps both, when a company invests in another company. So they purchase significant amount of stakes so they can influence the another company, but not have total control over the another company assets or decisions. So you have example like joint ventures, where this is a partnership between two or more companies to undertake a specific business activity, such as Crocs and Post Malone, okay, where each part receives a share of the joint ventures. Equity investment, like Berkshire Hathaway, led by Warren Buffett, when they invest is a variety of sector, this holding company. And when you talk about holding company, this is our companies that engage with another business is through owning stocks, right? So they don't engage directly in business operations. So like Berkshire Hathaway is one of them. So they invest primarily in industry like energy, real estate, retail. SoftBank is a Japanese conglomerate that invests primarily in technology companies such as Uber, WeWork, Alphabet, which is the Google or the parent Google company that invests in primarily in technology companies. For example, Calico, which is oriented to longevity. TPG, Texas Pacific Group, which is a private equity that invests in a variety of sectors: real estate, healthcare. Limited partnership, where now a company might purchase significant amount of the limited partnership in return of partnerships, assets, and operations. And also I look at the cash and cash equivalents, which is this money, for example, money market funds or money markets. When you have this money market funds, where now they invest primarily in very short-term debt financial instruments, such as bank acceptance, very short-term debt issued by banks, certificate of deposits, which is saving certificates issued by banks with short-term maturity, commercial papers, risky and unsecured corporate debt, repo, the repurchase agreement, in this case is very short-term debt issued by governments. So once I look at all of these most common operating assets, right? And from there, okay, this is just to understand the most common operating activities, operating assets, as well as the operating liabilities, right? Like accounts payable, money that a company owns to their suppliers and vendors, usually in the short term, 30 to 60 day, for things like raw materials, service, office supplies, accrue expense, expense that a company incur from good and service that has been received but not yet paid for. So, for example, salaries, wage, rent, income taxes or taxes in general, deferred revenue, which is obligations that a company has to provide good and service in the future based on money that has been collected, based on money that has been previously collected. So, for example, subscription service, Netflix, Amazon Prime, Spotify, or any of this logistics service, right? Such as UPS, okay, which is another great example here. So they have now a liability to provide a good most of the time, or a service in the case of digital online streaming. Okay. Also, gift card is another example, like Amazon gift cards. Income taxes, which is money that a company owes to the supply to governments, okay, whether it's a corporate. So this is money that a company owns to the government, okay, based on how much money they made and uh, based on how much money they made and the tax rate. Okay, so you have, for example, corporate taxes. So in the US, is something between 21%, which is very, very friendly to do that, to do business over there. In Latin, the average is 35%. So practically the government wants to live off you, but that's another whole different story. Okay. So yeah, you have is corporate taxes, withholding taxes, money that the employer deduct from the gross wage, from the gross employee's salary, and pay directly to the government. And this is to promote the pay-as-you-earn tax system and to fight tax evasion, as well as the sell taxes. but before jump into the sale taxes, on the withholding taxes, this is for when you have a relationship employer employees, okay. But if you are an individual contractor or an investor, you have to fill another form. Sale taxes like states or city, county, VAT, value added tax, which is a tax imposed on goods and assets at every stage of the production and distributions, where the customer ultimately pays the full VAT for that. Sorry. And business along the supply chains remit that portion to the tax. Excise tax, which is a tax imposed on specific goods like gasoline, guns, tobacco, alcohol, and GST, good and service tax. A tax imposed on VAT on places like Canada, Australia, and India. In short-term borrowings, which is companies ask for loans so they can meet their financial needs or working capital needs. So working capital is this different. It's a metrics. It's one of the metrics of to determine is the financial health of a company. To determine is the company's financial health. And here, well, working capital is it's different between the current assets minus current liabilities. So to see if a company has enough liquidity to pay its obligations, and this is just one metric for short-term financial health. Okay. And I also look at so bank loans, for example. So you have bank loans to line of credits, commercial papers. So the companies issue commercial papers so they can raise funds to meet their financial needs. Trade credits, where now they renegotiate is the payment with their suppliers and vendors. Outstanding invoice, so they show their invoice to a lender, and based on the value of that, the lender will provide some funds to that. Payroll advance. Company might be to provide advancing cash to their employees that will be deducted in the next payday. And when it comes to notes payable, which is another operating liabilities, so here this is an agreement between the borrower and the lender where they create a notes payable, or this transitory or notes payable, or a transitory note. Okay, so they create this note pay, outline the terms of condition of that loan. So you have, for example, bank loans. So anytime a company asks for a loan, it generates this notes payable, where they align is the principal as well as the interest rate, the repayment schedule, among other details. You have from banks or companies, where for companies that go to financial institutions, okay, like private equity or venture capitalists, yes, uh, they go for that route and they create these notes payable bonds. So from governments or companies, that once they issue that, they it generate these notes payable. Okay, outlying is the principal as well as the interest rate payment. A trades payable. This is now a negotiation that you reach. In some case, it's a negotiation that you reach with your suppliers and vendors to renegotiate is the payment to renegotiate payments. Okay. Also, look at the installments loans, but this is now for I mean notes payable, where now this goes directly to lenders from companies or business. Okay, so it doesn't go directly to a financial institution or banks or other company. No, it goes directly to lenders. So they generate is this agreement outlining all of the terms and conditions of that loan. So notes payable, as well as the mhm, mhm, uh, yeah, as well as the mhm, so as well as the warranty obligations. Okay, so warranty obligations are obligations that a company has to fix or replace a defective product or a product that doesn't meet certain quality standards. Okay, so you have manufacturing warranties, parts, vehicles, service. Uh, so with that, okay, once I was able to mention each one of them and understand is the operating assets as well as the operating liabilities, the operating activities or the most common operating activities, now, okay, now I can understand this a little bit more, the operating cash flow, all right? So the way to do that is by look at the way to conciliate that is by look at the total look at the net income from the income statement, okay, and adjust to any non-cash items, so items that affect the income statement. uh, mhm. Items that affect the income statement. Yep. So items that affect completely. Uh, so yeah, so items that affect the income statement. Uh, these non-cash items are items that affect the income statement without any cash involved. For example, amortization and depreciations or stock-based compensation. Just to mention a few one. And the other is it adjusts the total amount of cash that was used or perceived from other operating assets and liabilities. Okay, so this is the operating cash flow. Okay, the operating cash flow here, as you mentioned, the depreciation and amortization, deferred taxes, stock-based compensation, and again, this is part of the conciliation with the non-cash items. Okay, or other non-cash items. Okay, and change in working capital. Okay, meaning is exactly the difference between the current assets minus current liabilities. All right. Okay. So the second part of the cash flow statement is the investing cash flow. So it review is, well, the cash flow from investing activities that generally involves the purchase and sale of long-term assets, intangible assets, goodwill, property, plant and equipment, leaseholds improvement, that kind of thing. So, for example, if a company decide to purchase some equipment, that activity will be registered as a cash outflow because cash was used for that. However, if a company decide to sell some investments on their portfolio, well, this activity is registered as a cash inflow from that because cash was received from this. So investing is another long-term assets. Okay, and when it comes to financing cash flow, all right, which is here, I ask myself, okay, so what are the most common here? So what are the most common activity here? So what is the most common activities here? This is long-term examples, accounting policy, long-term liabilities examples, and long list of investing activities. So I ask myself, it's like, okay, so what does it mean, these financing activities? Okay, so investing and financing activities. So investing activities, okay, involve. So financing activities involves the company long-term liabilities and equity. It is very, very important to understand this. Okay, so this activity involves primarily raising capital from investors or creditors to fund the company's operations, pay or repay debt, and distribute profits to shareholders. So once I ask this to the Investopedia, holy hell. Okay. Let me go back here and say is financing activities. Okay, analyzing financing activities. Okay. So the cash flow from financing activities is this. So the financing activity is the cash flow statements focus on how a firm raise capital and pay back to investors through capital markets. But this is like this. Okay, so this is financing activities. So that's the end goal of this, you know? That's the whole idea of this financing activities. All right. Okay, is how a firm raised capital from investors and repay them. So how a firm or a company raised capital and paid back to investors through capital markets. Interesting. Okay. So that'll be all for this video. Take care. Bye bye.